So what we're going to have a look at now are managed funds, trusts and hedge funds. So what is a managed fund? What happens with a managed fund is the savings of individuals are pulled together and then invested in various asset classes, and that might be domestic or international investments such as property or shares. Managed funds have grown tremendously in the past, and even despite the financial crisis, funds are still flowing into, for example, Australia's superannuation funds, which are the largest part of the managed fund sector, and we'll talk more about superannuation funds later on in the topic. Managed funds in Australia are typically trust funds, and they're established under a document called a trust deed and managed by a trustee or responsible entity who act in the interests of these investors. And investors in the fund have a right to the assets of a fund as well as a share of the income or capital gains or losses that are derived. Now, the growth in the managed fund sector has been driven by deregulation, the wealthier and aging population, more educated investors, as well as the compulsory superannuation scheme. Now, where do managed funds get their money from? Well, for example, it might be payments into superannuation, which are then invested in a managed fund. It might be through insurance policy or even through individuals investing in managed funds. So what are the uses of funds? Well, what happens typically with large funds is they allocate a portion of the total assets to professional fund managers, and these fund managers then invest in different asset types based on the trust deed of a particular fund. Now, managed funds can be characterized by investment risk profiles, starting with the lowest expected return and risk, which is capital guaranteed funds. The way they work is the contributions are guaranteed but not future earnings, so their investments are going to be much lower risk and low return. So that's why they invest in things like government securities, bank bills, cash deposits and debentures. Now, as the risk increases, we will see more and more equity investments as a proportion. So if we move up one step to capital stable, this is still a low expected return and risk, but not as low risk as a capital guaranteed fund. Now, these contributions are mostly protected by investing in low risk securities. However, now a small portion of the portfolio may be invested in a riskier asset such as a share to try and increase the expected return a little bit. However, that comes at the cost of increased risk. We have balanced growth funds, which have higher expected returns and risk still. So here, the investments are in longer term income streams and include domestic and foreign equities. The highest expected return and risk are managed growth funds, and they're investing for a greater return through capital growth, and as a result they include a greater proportion of both Australian and foreign share investments. Now, let's have a look at cash management trusts. They're a type of managed fund, often by a financial intermediary. Because they're a trust, they're established under a trust deed, and they invest in short-term money market instruments, which is consistent with them being a cash management trust. Because of that, they provide high liquidity for the investor, and it gives retail investors an opportunity to access the wholesale market that they wouldn't be able to access as individuals. So what is a public unit trust? It's a managed fund which is established under a trust deed, given it's a trust. It's open to the public, so investors purchase a share in the trust, which is called a unit. And then the trustee pools those funds together that are received from investors and invests them on behalf of the investors. And the unit holders, the investors that is, receive a return either through income and or capital gain. This illustrates diagrammatically how a public unit trust might work. So all these investors own a share of the unit trust by holding units. That money is pulled together and then given to a fund manager who will invest it according to the trust deed. So different types of unit trusts might invest in different things, and that might be, for example, property or equity. So as we've just discussed, when this money is pulled together, it goes to these fund managers who invest it in different types of assets depending on what is authorised under the trust deed of a particular fund. Now, before we discuss hedge funds, let's just quickly recap the traditional managed fund or trust fund, which relies on the performance of the market or an asset class to drive returns. So for example, if we have a trust fund that invests in equity, the performance of that trust fund will depend on the performance of the underlying shares in that fund. Hedge funds, however, are structured differently and provide a lot more flexibility in their investment strategies. And these investment strategies include equity, foreign exchange, bonds, commodities, as well as derivatives. And these hedge funds can also use in their strategy leverage through borrowings, derivatives, as well as short selling, which is selling borrowed shares, and this makes them very, very risky. So effectively what happens with a hedge fund is the performance is not being driven by the asset class, the performance is being driven by the expertise of the manager in the choice of their strategies. Now these strategies are not always clear, and as a result hedge funds are often the target of criticism, which was the case in the GFC. Now these hedge funds are typically open to high net worth individuals who are required to invest large sums of money, but that is not always the case. An example of an Australian hedge fund is the Blue Sky Alliance Fund.